So, one of the most marketed and boasted financial concepts that we throw around when we start talking about wealth building, earnings on investments or return on investments is compound interest. Many of us in the financial space, whether we're content creators or overall financial professionals, tend to talk very highly about different investment products and strategies and mention compound interest and excitement in order to present the value of that investment or product without really taking the time to make sure that our audience understands or our clients understand what compound interest actually is and how it works. So in this video, we're going to discuss what compound interest is, how it works, examples of financial products that pay compound interest, and what it is against simple interest. What's the difference from compound interest to simple interest, and examples of what simple interest looks like as far as financial products. We're going to talk about all of that in this video. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, maximizing your borrowing capacity, proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I upload content on a daily basis to help you customize your blueprint for prosperity. So, what is compound interest? In simplest terms, compound interest is interest earned on your earnings. So, this basically means that interest is paid out on your interest that you're earning on that financial product. So basically, if you have $100 in a certain account that earns compound interest and it is getting, we'll just say 5%, that basically means that when that 5% breaks down over the monthly basis, and let's just say just for even numbers, it's $105. That means that the next time interest is paid out, it will be paid out on $105, not just the original principal of $100. So what that basically again means is that you're going to get earnings on top of the earnings. You're going to get interest on top of your interest. So if your investment starts out at $100, the first interest payment gets you $5, so you now have $105. That means the next interest payment is going to be on the 105, not just the 100. So this is a phenomenal mathematical scenario when you start talking about earning interest in a compounding matter, because what that means with time is that your money is literally going to start earning more money by itself versus you just getting interest on your flat principal no matter how much interest you gain. This is actually the difference from compound interest to simple interest. Simple interest means that no matter how much is accumulated in earnings, that interest rate will only pay out on that principal. So that means in that example, mathematically, that $100 example we had, if it's 5%, it's going to always pay 5% on that $100, no matter how much interest is accrued over time. So with that out of the way, hopefully that's clear for you guys. What are some examples of financial products that fit in each category? So quickly, when we start talking about simple interest, a couple quick examples are going to be auto loan payments and installment loans. In the vast majority of cases, the interest rate is paid strictly on principal. Now, mind you, this is going to be money you're typically paying out, but it works the same way. And good examples are going to be like auto loans or installment loans. They are typically, not in all cases, but in most cases, going to be simple interest products, meaning that the interest rate you're seeing is on the principal and not on the accumulated balance on that account. Some opposing versions of this, where you start to see compounding interest, is going to be credit card debt, for instance. That's going to be an example where if you let that build up over time, the interest is going to actually compound on the total balance, not just the original balance. Some positive examples of compound interest are going to be CDs, REITs, high yield savings accounts, REITs being real estate investment trusts, high yield savings accounts, dividend stocks, bonds, as well as money market accounts. All of these financial products all have compound interest that they pay out, not simple interest, meaning that you're going to earn interest on the interest that you've accumulated from the previous interest payment. So this is why financial professionals and other financial content creators are big proponents of compound interest, whether it's steering you away from it when it comes to debt or steering you towards it when it comes to investments. Because what happens is your principal now expands. Your previous interest payment becomes future principal that you're earning interest on. And that's a phenomenal mathematical equation. The more time plays out, because you can put in one lump sum of money, and if it's a compound interest product, it's going to snowball over time, because now that money is compounding upon itself, versus simple interest, where a product, you put in a principal, you get a simple interest return on it, and all you get is the interest on that principal, no matter how big the earnings are. So I wanted to put this out there because it's something I think some of us take for granted. I hope this gave clarity to you as you go further into your financial journey and you're dealing with more banking products and investment products and borrowing, to have a better understanding of what you're earning, what you're paying, and how to be careful with this so you can get the most out of your returns, pay the least on your debts. I want you guys to stay focused, stay in motion. And as always, I'll see y'all soon.